All right, you guys, this is being recorded. Yes, you will get a copy of this and watch it again. It'll help you guys remember some of the nuances, especially if you're newer to trading options. Second time through, it will help it stick into that long-term memory. So I surely think you should watch this again for those reasons. Plus, you know, that short iron butterfly, we're going to have a few extra rules thrown in at this one during this crazy time that we're having here. So we'll find something to put on here and throw out those guidelines. I don't know if I'd necessarily call them rules, or more guidelines to kind of lead our way. All right, so let me get a couple of things out of the way real quick. My name is Eric Wilkinson. I know there's a lot of faces out there, so it's like hearing a broken record, but I've talked about everything on mainstream media, from economic, geopolitical, and my market analysis. I've been trading my own money since college, and I started with a psychology degree, switched it over to finance. After graduating from college, moved straight up to Chicago. As some of you may have heard Alexander asking, or Trevor asking me if I miss Chicago. Yes, worked on the floor for over 20 years. And when the floor started shutting down, I was trading from home, and I was like, why am I in Chicago for these 3 months of beautiful weather? I do miss the food. That's probably what I missed most about it. And, you know, summers in Chicago are the best. But then now I moved down to Arizona, and it's sunny all year round, and you can't shovel snow. Anyway, I have seen snow down here once. All right, so please take a moment to go over this disclaimer. I may be talking about some stocks during this webinar that are in my portfolio. I am not trying to get you guys to follow my lead on any directional assumption whatsoever. As a matter of fact, in these webinars, I may even be talking about an underlying that I don't even really believe in, but it's for a hypothetical situation. It fits all of the guidelines, you know, rather than my market assumption or what I like or dislike about that company, okay? So keep that in mind, that we are talking about this, that we come up with, in this case, a neutral bias, and I can find something that fits all of the other rules. It's not going to necessarily be always associated to my market assumption. As a matter of fact, I throw it out to you guys to give me some suggestions on something that you're looking at, and we'll go through these guidelines to see if it fits the parameters of this strategy for that. Winners only, please. Well, that's all I do get. No, I'm kidding. 10,000% gain. That's what I love about people when they talk about, especially like this strategy. Had you put this on, you would have had a 700% gain. I don't do that. As a matter of fact, if you guys watch the daily market commentaries, I talk about the losers as well, and trying to turn those around. And, you know, if you've been watching since December, you've seen me take some heat, right? And I've been mechanical and lowering cost basis. And as a matter of fact, now I'm, you know, looking at a pretty good year. So please do your own homework, and remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right. You can follow me on Twitter at Wolfman's blog. Our parent company is at ProTrader Strat. So all kinds of market wisdoms and daily deals from ProTrader Strat. And you can follow us on Facebook at ProTrader Strategies, or ProTraderStrategies.com is an easy way to find us on Facebook. We're throwing out a lot of content on there, my daily market commentaries, if you want to check a couple of those out and see what I do on a daily basis. Really, it's very forward-facing. I'm telling you how it is and what I'm going through. I'm saying, hey, I'm sitting on my hands today because I really have no idea. And there's nothing wrong with that. You know, there's nothing wrong with sitting on your hands sometimes. And as a matter of fact, in those daily market commentaries, I'd probably talk about my losers more than my winners, because those are the ones that are top of mind and the ones that I need to stay on top of. All right. So the short iron butterfly, what is it? Why is it called an iron butterfly? Well, it's called an iron butterfly basically because it's, lack of a better word, when we would build it out on the floor. If you're talking about the option montage, you know, you got your strikes all in the middle. Well, you're basically doing those two, which, you know, you got your calls over here and your puts over here, right? And then you're going out and you're capturing this put here, and then you're going out and you're capturing this call down up there, all right? So in a sense, that's your iron butterfly. So that's kind of how that came about. So as you can see, we're basically going to sell a call and a put, and then we're going to buy a put to define that risk and buy a call out of the money there to define that risk as well. So that's how I understand it to be called the iron butterflies, because that's what it looked like when you kind of drew it up on a piece of paper. So we are looking for it to be range bound. I see a couple of questions popping up. Let me see. What's the difference between an iron butterfly and a butterfly? Okay, great question. So if you have your like strikes, you know, your 100 strike, 95, let's say just 90, blah, 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 and 105, right? 110. So on this side, we've got the calls, and on this side, we've got the puts. Well, a butterfly would be basically you're doing, you know, if I guess the at the monies would be the 100s in this case, just because that's the equal distance away. I guess I could do it either way, but I'm just going to erase that because I don't want to see it. Give me a second here to get back to my pen. So let's just say XYZ is trading right here at 100. That's the at the monies. So a butterfly is basically you're doing two of those, right? And then a butterfly is slightly out of the money usually, but and then you're kind of capturing, you know, the 95s and then the 105. So the just the butterfly is on one side, and if you did the put side, it would be the same looking on this side. Well, the iron butterfly, basically what we're doing is we're capturing one of each, a call and a put, and then we're capturing the put and the call, okay? So that's your difference. It's a call butterfly or a put butterfly, and the iron butterfly captures both sides of it. See what I'm saying? See, it does look like a butterfly. Trevor says that does look like a butterfly. Well, kind of. Maybe a 3-year-old's airplane or a Wolfman's airplane. All right, so we want range bound. Why? Because if we're selling a call and we're selling a put here, we want that underlying to stay relatively close to where that is currently trading. All right, let me get rid of that one. Because when we're selling a call and a put, you know, this is where we're going to be collecting money here. We're going to collect money there. That's going to be our credit, and we're going to collect a credit here. Well, if that is the main driver of this, because it's a short iron butterfly, right? We're looking at a short iron butterfly here. That is going to be a big collection of credit. Anytime we collect a credit, we want that premium to go down. We want to be able to sell high and buy low, right? Anytime you're doing something for a credit, you sell high and buy low. Well, same thing here. We're going to try and get these premiums to really go down in value, go to zero, really, all right? You know, not that we're going to get $0 out of it, but that almost never happens. You know, the underlying would have to be trade. It actually never can happen because, you know, it's going to be 1 penny. It's going to be worth a couple of pennies here or there. So, and another thing is we don't want to take this strategy into expiration because we are going to have the assignment risk if you take this into expiration because you're short a call and you're short a put. So somebody will probably, if you take it into expiration, you're going to automatically get assigned on one of those, right? So make sure you cover this. Well, I'll talk about the time in this trade. I would never ride this out to the end of the day for that assignment risk. Another reason is it's a lower probability strategy. Yeah, I mean, yeah, pretty good as if you wrote it into the end of the day, it has lower probabilities of success, but and you don't want the assignment risk. You don't want to be playing around in those last few days of any option strategy for that matter. So I always suggest getting out a little bit early, probably, at latest I would try and get out of this, a time stop, if you will, like I'm out of this trade would be like 7 days, to expiration is really where I'm looking to cover any option strategy that I have in my portfolio. Unless, especially in this case, I'm not going to talk about all the other ones. All right, so we want volatility to collapse. So right now we've had extreme high volatility. Is volatility at the VIX at 40, the new VIX 20? It might be for the foreseeable future. Sometimes I talk about, and I'll talk about it a little bit more, but volatility, we'll get like something to see a volatility like that where it's just an anomaly. And I'm like, all right, you know what? Discount that spike. It's crazy. Maybe it's, Pfizer or something like that had a drug trial result happening right there, and you'll get a massive spike, for those results. And, they might not have another trial release for another 7 years. We're seeing these kinds of spikes in Gilead every day for remdesivir, but, that kind of is the new normal for drug stocks right now, is every time there's a whisper that they have a solution, you're getting those crazy spikes in volatility and in their stocks. But what we want to do is we want to see volatility to be at relatively high levels, and the expectation that Vega or volatility, and I'm not talking about VIX necessarily, this is Vega for that underlying, is expected to come out of that particular underlying. The VIX is an overall gauge of volatility in the markets, okay? It's basically a measure of the demand for buying options, and that's how that index is created. But every single underlying has its own implied volatility coefficient, in a sense, where it generally, before 2020, would stay in a relatively tight range. Now we're seeing extremely high volatility, so we're going to have to start taking that into account. And I'm going to talk a little bit more about how we're going to approach that going forward for different types of strategies like this. All right, so I kind of went over this. You can think of it in two ways. You're basically selling a short call spread plus the short put spread, right? I talked about it. We're selling those at the money calls and then going out of the money or higher in price and buying a defined risk there. Same thing. We're going to pick the same strike for the short put and then go further out of the money or down in value on those strike locations and buy it to define it. So you could look at it like it's a short call spread and a short put spread jammed together, as long as the put and the short call are the same strike. If they aren't the same strike, you're looking at an iron condor, okay? So that's a little bit different of a strategy. You could look at it as a short straddle plus a long straddle. I like to look at it as, hey, it's a short straddle and we're defining the risk. That seems like the easiest way to talk about it in my eyes. Basically, a short straddle, I guess you have to understand, is the at the money. So the short straddle is the at the money strikes, okay? And then we're going to go to define the risk. These are out of the monies. It's an out of the money call and an out of the money put, but these are at the money. And it's going to be very close to, the calls and the puts are going to be very close to a 50 delta on this, right? 50 delta call, 50 delta put. And why do we want it to be range bound? Remember me talking back here, we want this to be range bound. Another reason why we want this to be range bound is when we build this out, if I said we're selling a 50 delta call, right, and a 50 delta put, well, that's a 100 delta. That's going to end up being, that's going to end up being short 50 deltas on the call and then long 50 deltas on the put, right? Because if you sell a put and this is a negative delta and you're selling a positive delta call, right? Selling a positive delta call, that makes it negative. So a negative 50 plus a negative or a positive 50 equals, equals 0 deltas. All right, and I'm throwing this out there. I try to say it once, let it kind of meld in your brains, all right? And then when we go through it, I'm going to pull up a platform and all that stuff, and we'll dig into that. But know of this being a delta neutral strategy, which means we aren't biased to either direction. Yes, we might have 1 or 2 deltas in there, you guys, okay? You can almost never get it 0 deltas exactly. But what we're going to try to do is build it as close to delta neutral as we can, all right? And I'll show you, we'll go through this like, with baby steps too. All right, our max profit on this is the premiums received, right? So with this strategy, though, something to note, we're going to try and risk 1 to make 1, So if we collect $5 on a $10 wide butterfly, we're risking 1 to make 1. So keep in mind, we want to get a collection, but also look at this as, what is my risk that I'm willing to take on this, all right? And because it's a defined risk strategy, I always say, I'm willing to take my max loss on this. So look at this strategy as if you were going to lose it, all right? Now, I'm confident after building this out. I've set myself up for success, right? I've done my homework, but I also want to know what I'm going to be able to lose on this trade, all right? Especially because it's defined risk and what I'm willing to lose on this. I mentioned before this, if anybody had known, David Portnoy, and something, he's the guy that started Barstool Sports, but he was saying he was going all in on Amazon today, buying Amazon going into that earnings. And that's just not smart. I don't care how sure you are of any trade. If you want to be in this, and I tweeted this out, if you want to be in this business for the long term, if you want to be able to have money at the end of the day, then never, ever, ever go all in on anything. All right? I don't care how sure you are. It just, the market will beat you up. And especially as a newer trader, keep your risk and reward, like you aren't risking any more than 10% of your portfolio value on any under specific trade, no matter how sure you are. Yes, all in is kamikaze. Yes, I mean you are literally. I mean it's not worth it. And Amazon tanked after hours. He might be okay, but at the end of the day, it was silly. And I'm sure there's a lot of people that jumped off the cliff with him. All right, so don't ever do that. All right, long call, max, we're going to have 2 possibilities of max loss, but it's going to end up being the same total. This is just if it's basically the width of the spread, right? Our long call minus our short call. Our short call is that at the money, and the long call is the one that's higher, right? So, in my example, we were kind of looking at like, in this case, we were kind of looking at the 110 calls on that one when I was drawing it up on the butterfly, right? And our short call was the 100 call. So we've got $10 wide. Well, I would have expected to, pay more or collect no more than 5 cents, or a little bit more than 5 cents, hopefully, actually. No less than 5 cents, I should say, or $5 on this. So I would never collect less than 50% the width. That's another little thing to keep in mind. All right, so then our max loss is equal to $5 on it rallying too high, right? Because once it gets above 10, because remember, we can talk about our break even. If I collected $5, my break even is 105, right? And then that $5 up to 110 is another $5. So then that's my defined risk. I can't lose any more to that side. And then on this one is that short put. It's that same strike, 100 put. and then we would have been looking at the 90 put here, and then minus that $5 credit. So, you know, my max loss to the downside is also $5. And it's got to be an or, right? It can't go in both directions at the same time. It can only go one direction, right? The markets can't split. So I kind of talked about the break even a little bit already, and it's that short call minus or plus the premium on the upside. So we were talking about the short call was that 100 call, and plus the premium, which was $5. You got a $5 credit. So my break even is at 105, right? This is the break even. And then on the other side, we've got our short put, which was the 100 put minus the $5, because you got to think that $5 credit, this $5 credit is helping me out on both sides, right? That's in my pocket. So as the market goes down, 95 would be my break even when the underlying's trading there, all right? Everybody with me so far? The beauty in collecting a credit is you get to add that distance or subtract it on the put side to your break even. When you're doing it for a debit, it's a flip, right? You got to make up that difference. Right now, I've got, when you get a credit, it gives you a buffer zone. The debit kind of puts you behind the 8 ball in a sense where you got to make that up. Hey, John, glad you made it. All right, so think of it that way as well. You know, when I get a credit that's in my pocket, that gives me a buffer. When I pay out on something, I have to make that up going forward. Okay? All right, so we got some, these are the guidelines that I'm talking about. When we're talking about picking the right underlying, it's not like we're going to be talking about going out there and grabbing AutoZone. We want to have something that is going to have a tight bid ask. All right, so my rule for this is picking something like Amazon's going to be all over the place right now. Let's look at GLD. All right, so GLD is the ETF for gold, all right? So what we're looking at for something that is over $100, we want to go to the spot month. And, you know, it's right in between right now where the spot month is, but I would have to say there's still more eyeballs on this 15 days to expiration here. So what we want to do for this rule is any stock over $100, we move this decimal 3 ticks to the left. So about 16 cents wide is what we're looking for right here. And ETFs will almost always fit this rule, even after the market, which we're after the market's closed right now. So people are going to be canceling orders and it's going to get a little bit wide. For instance, Apple, 3 ticks to the left, we should see about 30 cents wide down here on these. As you can see, that's working out and fitting that rule. And another way to do it is if, you know, especially because we've been seeing a lot of volatility. Volatility makes these markets a little bit wider because the people that are making the markets aren't willing to take that much risk, right? They're not willing to give up really tight markets because they got to run and somehow try and hedge their risk. They're always looking for arbitrage. They're always looking to hedge their risk. They're not just looking for speculative positions when they're making markets. They're always looking to try and hedge their bet. So if they have to sell a call or have to buy a call, then they have to, if they bought the call, they'd probably be running out and selling a put or buying another call to create a spread. You know, they're looking at legging into a hedge. And therefore, if it's really swinging back and forth, they know that by the time they go over there to hedge themselves, the market's likely to have moved maybe dramatically. So, you know, the way that they look at it is, well, I'm not willing to pay the price I believe I should be buying it at. You're going to have to come to me because I am believing that I'm not going to be able to offset that for the price somebody else is showing me. Does that make sense? It's just there's too much risk. By the time, you know, if I were to have sold these calls to somebody, say I was on the 300 calls and I wanted to sell the 300 calls. Well, by the time I sold those 300 calls and went out there and bought the underlying to do a covered call strategy, hedge my strategy, I'm just looking to make that $7 as a trader. By the time I go there and buy the stock, it could be trading very close to 300. So I've lost a little bit of my margin on this trade. So might not be willing to give up as much on that edge. Hope I didn't lose anybody, but you get what I'm saying. If I had to sell something in here and then, run and offset it in that time, as quick as that is, 5-10 seconds, as we've seen these markets swing, and that is kind of their risk premium, if you will. Probably the best way to say it. The credit is not in your pocket until you close it. No, as soon as, one of the beauties is with collecting a credit, for instance, if I, even with anytime you collect a credit, you get to keep that credit. Now, if you go and buy it back, if I sold it for $5 and I had to buy it back for $8, right? Well, did I lose $8 on that trade? No, I only lost $3 on that trade because I got to keep that $5, right? Just kind of like, on covered call strategy, like I'm talking about. If I bought this at $2.90 and I sold these 300 calls for $5, right? And the underlying traded up to 300 and I got it called away from me, well, I still got to keep this $5. You still get to keep that $5 if it gets called away. So in a sense, it's like if I bought this at 91 right now and I sold these at 300 and, in the next 15 days, it was trading 305, right? Well, yeah, I got that stock called away from me at 300. So I didn't get that, I bought it at 91. I said I got out at 300. Well, I made $9 on the trade. I got to keep that $5. So, in a sense, even if it's trading at 305, I didn't really lose anything. Got called away from me at $3. I still got to keep that $5 in commission or in a credit minus commissions. All right, so Apple would fit that rule, and then you can go and look at something that's below $10 or $100, and basically the bid to the offer should be within 10 cents. Okay, and that's during open market operation. Sometimes when you're doing your analysis and it's after the market closes, it may not fit that rule, but that's because after the close, all these orders are getting canceled. So that's the general rule of thumb. In these markets with the volatility the way it's been, you guys, it's a little bit wider than that. So just know that there is more risk involved for these market makers. So that rule is, for a green light, let's say, inside of this rule that I'm talking about for picking the right underlying is a green light. If it goes somewhere, especially in these markets, and in the past, I would never say if you doubled it. So, a stock under $100, 20 cents wide would be a yellow light. If I'm looking at Apple, a green light is anything under 30 cents, and from 30 cents to 60 cents is a yellow light. Anything more than that, I would say it's a full-on red light. Just don't even trade that underlying. Okay. All right, the right environment. Well, we want high volatility, right? Because I said we're doing this for a credit, so we want implied volatility percent to be high. And now for a stock, I want that to be greater than 50%. 50% is what I say. And then for an ETF, we want this to be greater than 30, all right? 30%. And I'll go over what implied volatility percent is. Basically, when we're looking at implied volatility percent, you're going to take the current IV, implied volatility, right, minus the low implied volatility. You take that sum and you divide it by the high implied volatility. Whoops, volatility. That was terrible, Eric. Minus the low implied volatility. Okay, so you're going to take that and divide those two sums by each other then. And the reason why we want that high volatility for it's that underlying, right? You know, if I just look at, you know, implied volatility and say, all right, it's around 80. Well, that's above 50, Wolfman. No, it's implied volatility percent. What we're saying is, where is that 80 in relation to where the other 52 weeks has shown us? So when we're looking at this on a platform, there's a couple places you can actually find this. For one, I have it in the watch list. I have the code or the how you put that in there. So you'll have to reach out to us for that. But also right here, it's implied volatility percent. I do this because I like it in the watch list. I mean, this determines whether I'm buying or selling, buying way down low or selling premium in any directional assumption I have. So, you know, if I'm bullish in IWM, then to me that this would be some type of premium selling strategy, because remember, IWM is an ETF, or it's going to have a basket of goods, or above 50, Gilead being above 50, right? So those would, to me, would be like premium selling strategies. If I had a bullish assumption, I'd be looking at selling probably puts. If I had a bullish assumption in, let's say, Procter & Gamble, you know, this is really low. So I'd be looking at premium buying strategies because volatility is so low for itself. And when we look at that, we go over to the charts, and this is where the implied volatility model is. And you can see, like, I can go out probably 3 years and see volatility is never really been that high. As a matter of fact, you know, this was the high before that. So if volatility comes back to normal, then there's going to be a time where, remember I said, you take the current, which is 28, minus the low, which is, let's just call it 10, 28 minus 10, and then the high is 94. Well, historically, the last 3 years, the high has been 32, right? So we can see that what has happened recently is somewhat of a black swan event, So we might want to discount that further down the road. I'm not saying do that, you know, in the next month or two, but, you know, 4 or 5 months down the road, we start seeing it come back into normalcy, into this range, which you can see normally it would never break out of that range. We could say that that 28 is extremely high for something like Procter & Gamble. Right, so you can't just take exactly where it's currently at. You have to put everything into perspective, where it was before and where it is now. You know, Gilead's going to be very similar. You can see before, even on earnings and stuff like that, the high used to be about 46. That was like extremely high. That's like premium selling strategy with ease there. But, you know, of course, you know, it doesn't always mean that's the high. It just has a tendency to stay in those ranges for certain underlyings, okay? So, you know, a 61 for Gilead might be really low for something like Tesla, right? If I go and look at Tesla, it's 84, and, you know, 31's about the low there, 28, but 81 doesn't really tell us anything, because for Tesla, you know, that's back into range and probably a little bit higher. So you can't just look at the 81. You can look at gold. Can't look at just 24 implied volatility because, you know, it never gets above 50, even with all of this going on. It normally wouldn't get above, you know, 17, and it's at 24. So you could say it's pretty elevated. Does that make sense, you guys? So just knowing what volatility or vega is for the underlying when we go over to the option montage, you know, knowing what this number is doesn't tell us anything, really. It doesn't tell us if that number is high for GLD or if it's low for GLD. You know? So you got to try and compare apples to apples. What does this implied volatility number mean? Yes, it is a percentage here, but what does this implied volatility mean? Well, we have to figure out where it is in relation to where it's been in the past. Okay. So with this one, we want high implied volatility. So, you know, GLD being a 38 is, you know, above my threshold for an ETF. So that means it would fit that rule. So if we're going to try and compare apples to apples, and I know you guys like to look at the Analyze tab, we can look at a couple of them. This is EA Sports with a pretty high implied volatility, right? It's a $100 stock. And we go over to Caterpillar, where implied volatility was very low for it. So this is the difference. You know, it's hard to compare apples to apples on this, but you can imagine they're still $100 stocks. This one's, you know, $114, $115, and EA is trading around $119 on this example. But this is just to give you the idea how much wider you can get those break-even points, all right? So implied volatility, because the strike we're selling right here is so jacked up with premium that it's allowing us to get further away on our wings, all right? These are the wings that we would have been using there, all right? So those are the ones where you're buying the put and buying the call, right? And then you're selling a put and selling a call at the same strike there, all right? So those would have been like the 120s, all right? So in this case, you know, you're looking at risking, you know, looks like 475 to make 525. So a better than, you know, risk one to make one kind of strategy here, just slightly. But then when you have the low volatility, all of a sudden your legs come slinging in. All right, so the duration, what do we want? We talked about this. We want to have the tight bid ask. So this is like a tight bid ask, bid to offer on the option premiums offer. All right environment, we want high implied volatility percent. We talked about that, above 50 for a stock, above 30 for an ETF. And the duration. Why do we want that implied volatility percent to be high? Maybe I forgot to mention this. Is because when volatility comes out, right? When volatility goes down, volatility affects those premiums. When volatility goes up, those premiums get pumped up. Well, when volatility comes out, those premiums come out, all right? So why do we want to collect a credit when premiums are high? Is because when volatility comes back to normalcy, and we're seeing volatility come back into normal realms of expectation, well, as that volatility comes out, those premiums start coming out. And as the premium comes out, we are able to achieve our target exit, all right, much quicker. You know, if you pick it and all of a sudden that volatility comes out and the market stayed right there, then you're good to go. You're good to cover this trade rather quickly. And the right duration, we want Theta. Remember, Theta is the thief in the night that comes and steals your premium. Volatility crush benefits. Yes, this is volatility crush when that happens. That's something we used to call it on the floor. Yes, you loved volatility crush when you sold premium. And picking the right duration, we want Theta, thief in the night that comes and steals our premiums, right? Longer duration those options hold on to it. Yes, theta happens still every single night. All right. Theta comes and takes a couple of pennies from you every single night. But once it gets closer to expiration, he gets a little bit more aggressive. He comes in and starts taking a lot of that premium. The closer to expiration, the more he takes. So the idea is to get inside of this little wheelhouse. And 35 days to expiration to about 7 days is the wheelhouse I like to be involved in these strategies. I like to get in right around that 35 days to expiration, take advantage of all of this theta decay, because look, we get a 50% drop just in that time. And that's on our at the monies. We're doing an at the money call and an at the money put. We want this type of theta. We don't want to get out here in 98 days and just see like pennies ticking away. All right. But another thing to think about this as well. We talked about Vega really pumps up those premiums. Well, you can think about this. As volatility starts expanding, it pushes up on this curve and it'll make those premiums do this. Well, you get inside this day here and all of a sudden that volatility starts coming out, it'll start catching up with it. So if you can get in around that type of situation, you know, your premiums are going to be a little bit more elevated than what is, you know, expected in a sense. If we're looking at option pricing here, right? You know, your premiums kind of get pumped up a little bit from the Vega, and you can catch that that volatility crush. It's going to make those premiums catch up with normalcy because, yes, theta is still happening in here. But that volatility and everything else comes out. That's what creates the difference in, you know, what we were talking about. If this is the break-even line, you know, that's what creates a analyze tab that looks like this versus one that looks like, you know, I don't want to get over there to confuse anybody, but an analyze tab that looks like that, right? We want this one. We want our break-evens way out here. And that's what volatility does. A normal one without any volatility follows this line, which is still okay. This strategy, you're going to be able to, I'm going to have a couple of, you know, guidelines coming up, you know, that you can build this butterfly in any type of environment. It will work out where, you know, I've said the collection, we want to get a collection of credit that is, you know, 50% the width of the spreads. Well, you risk one to make one. Well, yes, you're going to be able to do that even in low implied volatility environments. But we want a situation where we get way out here, and then when that volatility comes out, it starts looking like that, right? Starts, whoop, comes in. Because that means our premiums have gotten sucked out. All right. All right, so picking the right strikes, one of the things I talked about this is we want to make sure that when we're doing this, that we collect 50%, right? You know, we want to collect 50% the width, our collection on this, all right? The width of the strikes, collect 50% the width. All right, what ends up happening, you guys, and this is another little hack for you, what usually ends up happening is we're going to kind of have that defined risk where we're going to look at defining that risk at around the 10 delta. Okay. That means that's where we're buying the call and buying the put. We're going to start to look at around that 10 delta. Sometimes we're going to have to go in a little bit tighter, maybe to 11, the 12 delta. And the calls and the puts may not be exactly 10 deltas, right? You know, the call might be a 9 delta and the put is a 12 delta. Well, that just means that there's put skew, okay? That means people are putting on protection or buying puts more than they're buying calls, all right? So there could be a little bit of a skew. So it's just kind of a rule of thumb to give you a starting point. So you're not just like picking willy-nilly and just, all right, well, what does this look like? What does this look like? It'll streamline that process for you, all right? And we're going to try and get this to be delta neutral, right? So we want to try and get as close to delta neutral as we can. Why? Because we believe this underlying is going to go sideways. If we thought there was a directional assumption, a directional move going to happen, then there's better option strategies out there with, maybe higher probabilities. This is one of those things where I pick the iron butterfly to be at the money. Yes, you will see some people say, do this iron butterfly, out of the money at, a 36 delta or whatever strike they're picking, because they believe the market's going to move to that point. Market's right here, and I think the market's going to move to that point. Well, let's put on that iron butterfly right there. And when it goes to there, I'm going to have a 10,000% gain on this trade, which some people will do that. If I had a bullish directional assumption, there was probably higher probabilities to be had out there using a different strategy. So to me, the iron butterfly is very neutral, right? It's hard to find great strategies that are neutral. One of them is the straddle. If you're selling a straddle, you're very neutral. Well, this, if you have a little bit less risk tolerance, or we're in an environment where we are right now, where anything could happen tomorrow and really cause the markets to move, I want to have that defined risk so that I'm not risking too much at this point. All right. So great strategy for right now. In the past, I've always said, if you have a high risk tolerance, I'd lean towards the straddle. Well, I wouldn't do that right now. I would not do the straddle, a short straddle in these circumstances, just because who knows what's going to happen tomorrow. Also, another way to, other than look, I see some questions coming up, but I just thought of something. Another thing is kind of like you're going to move out 2 times the credit. So the wings are going to equal to about 2 times that credit received. Remember we talked, so the wings being that point, and we got a credit of $10. Got a $10 credit there. Well, it's probably, $20 that way and $20 that way. But it usually ends up being about the 10 delta is the easiest way to look at it. Do you get a recording this session? Sorry, joined late due to job. Yes. Thank you for being somebody who is not expendable, I guess, Sam. It is being recorded. You should be getting a video of this, or you can check on our YouTube. It might be popping out there next week. All right. Can we have a calendar with the deltas being so close? No, you can't do this as a calendar. Yeah, it would just be a calendar. I mean, I'd have to really think about that. All right, so our exit strategy. I'm looking to get out. So I'm getting out for about a 30% profit. Now, if you have a higher risk tolerance, you could say I'm getting out at 50%. But believe me, I would not want to push it much further than that. Right? This strategy, because we're doing the at the monies, it takes a while for this strategy to work out, and it will take a while for you to be able to get that 30, especially 50%. And like I said, you're never going to get 100%. And if you're trying for 100% on a straddle or an iron butterfly, I think you're going to be very disappointed. There's being able to nail that number that far out is very difficult. So is this a good earnings strategy play? Yes, one would say it is. You will generally have a collection of credit that is very close to where that market maker move is. And if you expected the underlying to trade very sideways, even after the earnings, like all is kind of priced in for that, then yes. You know, it would not have been a very good one for Amazon today. No, because I don't think you would have been able to get enough of a credit to fit that. As a matter of fact, it went out to the 16 delta, the 1 standard deviation move today. And I think that you're going to end up being at around a half a standard deviation with this strategy. So when we talk about that bell curve, you know, we've got a half a standard deviation right here, which is about the 36 delta. 1 standard deviation is about 16 delta. All right, that's on the put side. Same goes for this side and this side, you know, it's 36 delta. So, and our defined risk is that 10 delta. So, you know, our defined risk is further out here, but we are going to probably start to lose money somewhere around, you know, around the 36 to 26-ish delta. And we'll look at that when we pull up this platform here in just a second. I think there's other strategies out there, Raj, for earnings that I would rather use. And I actually I have webinars specifically for earnings. All right. Yes, you are going to get a fat, juicy credit for this one. But to me, especially right now, it seems like a little bit more risk than what I would want to do for an earnings in this case. You know, I'll give you a number here in a minute. I don't have a link for that. And I'm the only one on here, so I don't have access to the, I'll just write down your name. All right, Raj, I got you down. I'll reach out to somebody for that. Or you can call us here in a minute in case I forget on that, right? Thanks. I'm really relating to your style of teaching. Oh, thank you. I appreciate that. All right. So another thing to think about, you guys, we want that volatility. And, you know, if we can be right with this, that doesn't happen often. Thank you. I appreciate that. If we can get this trade moving in our direction quickly, then I want to get out, and I don't really care. We're getting a big credit. So, you know, 10% of your max profit in less than 10 days, and this is going to be, you know, less than days in the trade, kind of think of it that way. If I can get 10% profit in less than 10 days in this trade, if I've gotten, you know, a $5 trade on and I've gotten 50 cents in less than 10 days, I'm probably going to take this off, because that means in 10 days, it's just basically traded sideways. And, you know, obviously, if you were in it for 10 days and had 20% profit, then I would for sure take that off. So, you know, these are kind of just guidelines. If you're in 15%, you know, 20%, 30, 25 days is probably where I'm looking to get out, and 30%. So wherever at 30% on this strategy is where I'm looking to get out. And if you can get 50%, then, you know, you have a high risk tolerance, higher than most people. So let's pull up the platform, throw out a couple of examples. I'm going to look at GLD because I think that GLD is kind of stuck in this little area. If we take a look at the daily chart of GLD here, pull up my trading thing here, see what color I got on. Let's throw on white. I think that GLD is going to kind of maybe go a little bit higher than there, but I think that GLD is going to kind of stick in and around this. Yes, you could say the Fed's printing money and this is tied to dollars, and that's going to drive the market. But I think that 1700 in gold is going to hold. I don't think it's going to necessarily go to 1800, but I think that this is shown as a nice resistance area. But we can see we've gotten some resistance up around this area. We've gotten some support around that area. So it seems to me like it wants to maybe go like that. All right. That's my assumption. That's how I came up with my assumption. You may not believe in this assumption whatsoever. You might think I'm off my rocker, but you know, I'm coming up with a theory and I may not necessarily believe in that assumption in my real life, but let's just say, you know, you're looking at the charts and you're saying, okay, look, it's staying between this area and this area. And you're looking at it, yes, I think that this area is the zone where gold is going to end up in the next, let's just say it's even in the May, because we could do a pick 'em here, May and June. May and June, I think it's just going to stay within there. It might jump out of that later, but for the next month or so, I think that we're probably going to start consolidating and figure out where we're going to go. Can you do in GLD? Yeah, I will. So I'm just throwing out a chart for people that may recognize the pricing on gold. So, and they're going to correlate. So if I pull up the GLD platform and throw in the same thing, that's kind of in line with what I'm talking about here and there. So if I believe that GLD is going to stay in line with that for, at least to here, I'm going to be looking at, this contract right there, which is going to be the June. And if I just want to be in this a little bit shorter, I could look at the May. Sorry. It doesn't like it when I draw straight down, I figured out finally. Took me a while, but it doesn't like that, but I got to do it. All right, so gold. One of the things I talk about is closest to 35 days to expiration. Well, 50 days is a little bit far out, especially for what we've been going through lately. It seems like an eternity. So I'm going to just look at this trade a little bit further in, just to, I don't need 600 of these. Let's just go 14 and see what we got. See if I can get my parameters in here in GLD. Probably not. Let me go. All right. Still not out to a 10 delta there. Let's go 50. All right. So I'm just looking here to see where my lines in the sand are. All right. So what's the closest? What's the at the money? I'd say it's the 159s, right? I'm going a little bit closer. It's not that 35 days. And yes, it's very close to where I would want to be getting out of this. So hopefully I'm not going to be in this trade for very long. Anyway, so we'd sell the 159s, right? So I sold the call and I sold the put. That's the at the money. And here's what I was talking about being delta neutral, right? Delta on the calls is positive because everything's considered to be a positive delta. You go up $1 and the premium is affected by the delta. For every dollar move higher, delta adds into the premium, right? Well, for every dollar move higher, delta over here on the put side is negative. So it comes out of it, right? So if another way to look at this also is if we sell a call that's negative, a negative plus a positive is a negative. So those are negative deltas. So that would be, you want to go down. And when we sell a put, that's a negative plus a negative equals a positive, right? So in a sense, we got negative 49 plus positive 51. All right, well, we're slightly positive 2 deltas. That's why I was saying you're almost never going to get it to be exactly delta neutral. As a matter of fact, you can tell that market needs to go a little bit higher for those puts to come to 159. But it's close enough for government work. All right, so I also said we're going to look at that 10 delta. You could also say, well, I need to go, 2 times the credit, $10. So I'm looking at 59. I'm probably going to be looking at the 49s. Looks like we can do the 49s. Hopefully we can do that to the upside. As a matter of fact, I should check out the calls just to make sure. 59 and 69, so we can do that. All right, so the 60, so we're going to go 10 higher, 10 lower. So 59 to 69, I'm going to buy these. And if you're building this out the way I'm doing it, you got to hold down the control and hit the click. If you go over here and do the single, you'll be able to find butterflies and iron butterflies and stuff like that. It's actually going to call it an iron condor. But, you're going to have to mess around with all the wings and everything else. So I just prefer to do it this way, to build it out proper. So we went $10 up. I got to go $10 down to make this equal distance. right? Buy that. All right. So $10 up, $10 down. I'm not quite getting that 50% the width of the strikes. As a matter of fact, I'm risking more than I'm able to make, you know. I need to have this be a little bit higher. We can go over and look at it on the analyze the trade. And you'll see that, you know, my risk to the downside is over $500 and my reward is less than $500. So I'd probably play around with these legs then and say, all right, well, let's take the, come in a little bit, see if that helps me out. So the puts, I'm going to go up to 150, and then on the calls, I'm going to come down to, I went $9, so I want to come down to 8. See what that does. So now I am $9. So that's right there at risk 1 to make 1. So that's why I was saying, you know, you want to start there, play around with it. I did have to come in a little bit, but I did get my 50% the width of the strikes. Now I can go over and look at the Analyze tab and delete the really wide one, which was the first one here. Get rid of that one. And you can see that now I'm risking 1 to make 1. So that works. I got pretty wide markets on this. You know, you could look at your Fibonacci's and say, you know, where's my risk? Where are my Fibonacci's? You know, 154 to 160, 163.5. You know, I mean, that's basically right in line with what I was talking about, right? 163.50 or something. You know, I said it would stay within those, and so that would fit my thesis on this trade, right? Even if I said, hey, you know, it's going to trade within this range, and I got those break evens, you know, not even where my defined risk is, but my break even is inside of my range. I think that that's something that I would definitely look to go with. Gold will go up at least to 25,000 in the next couple of months, easy. All right, you heard it from Alexander. Do not put this on then. Accumulation is what we see now. I'm not going to disagree with you, especially with the way that everybody is printing money. I'm just saying, you know, if my thesis was, you know, whatever, even let's just say this is XYZ, who cares what it is, right? I'm just coming up with, you know, it's got an ETF that's above 30. It fits all of those rules. You know, my market assumption for a butterfly needs to be that it is neutral, right? So I have a neutral market assumption, all right? I'm not saying I'm not bullish in gold either, but I'm just saying I've looked at the charts. It's XYZ. I've got a neutral market assumption. What's the best trade for this? You know, the first thing you're coming up with is why you have an assumption, right? Usually we say, I got an assumption in this, and then I want to put a trade on around it, right? So on this, I'm just saying I came up with a neutral market assumption. I go and I look, is it the right underlying or is it the right environment? Yes. It's got high implied volatility. Is it the right underlying? Yes. We saw that this XYZ has tight bid asks. Duration, it's right inside of 35 days. There's not a sweet spot for that, but 35 days to expiration is the sweet spot, right? In this one, we're looking at 15 days. Do I want to go out to 50 days? I don't know. You know, so you can default in, especially with the volatility as high as it is right now. You know, I mean, this says it's only at 37%, but you can see that way higher than normal. So it gives me a nice buffer for this, but I've got a neutral market assumption. I've got the 50% the credit, and I'm going to be looking out somewhere between 30 and 50% of my max profit to get out. You know, on a $4 credit, right? 30%, I'm getting over $1 on this trade. That's a pretty good winning trade in my eyes, right? If you collect $1 in 10 days, that's a nice trade. So that's something I would look at there. Another one we could look at, let's just say, because Facebook just came out, right? Now, you know, I said we want high implied volatility percent going on. Well, Facebook just had earnings, you know, so all of the news is out. You expect volatility to continue to come out. Let's just say that's part of our assumption. I think that Facebook now is probably not going to, I mean, is it going to make all-time highs? Well, I don't know. Anybody making all-time highs right now, besides maybe the gaming stocks, I think, or like Microsoft or something like that, I think is going to be a tough stretch. Yes, I think there's a lot of people on Facebook right now, and it's amazing how many people are on Facebook right now just after watching their earnings. But we're also seeing their ad revenues go down a little bit. Yes, they have a lot of physical things you can buy for video conferencing and stuff like that they're doing very well on. But I think that, you know, I'm just coming up with an assumption. I'm trying to make a case for, you know, the market trending sideways in and around this area, right? So I'm saying, you know, those are kind of my parameters on this. So I go over and I'm like, okay, so I've got a neutral assumption in this, and I'm long Facebook. They're getting called away from me. So let's go a little further out. So I'm not trying to get you guys to follow with my assumption here. I was bullish in Facebook to 200. So it's trading right around 200. So that's where I'm going to kind of go out 50 days, $200 stock, move the decimal 3 ticks to the left. Yeah, I can trade options around this. They're fitting that guideline. I'm going to try and pick the at the monies. 200's the at the monies on this. So I'm going to sell the 200, sell the 200, $20. So that means that basically I can go at least $20 in this, right? So $40 is what I should be looking at. So I'm going to pick the 165s because that's right around that 10 delta. 165. And then, so 200 to 165, we got 35 there. So I'm going to go to 35s here to make that equal distance. And I'm going to buy those. So I've got a 35, in this case, I've got a $35 wide. I probably could go out a little bit further, like to that $40 wide, really, to make a risk one, make one. But when we go and look at my charts, I think about the 200 strike plus that $20 credit. I'm right there at the all-time high, or very close to it, right? That I don't think is going to happen. And to the downside, I said 70. So with that $20 credit, I'm not quite down to that level, but it's pretty close. So that might be why I bring those wings in a little bit. I got 3 shorts. Oh, that's a problem. So let's do this again. So sell, thank you very much, John. Sell those 2, sell one, and then what did I say, $35 to the upside. I'm buying this one and then buying the 35 to there. Right. Okay. That was why it was a really nice credit. Now it's a little bit close. I mean, it's still $35 wide. So, you know, that's more realistic, to be quite honest. And that's why. So it's very close to it, a little bit better. We can go over and look at the Analyze tab too, where we can say, this is also where I see iron condor. It's not an iron condor. It's an iron butterfly. Check the Analyze tab on this. It's going to show my position, which we don't want to do. Actually, I don't really care if you see the position in there. It's a winner. You can see I was long 175. I got put the stock at 175, started lowering my cost basis. I can't remember how many times I did, but it's called away from me. Yes, it's trading above 200. These calls, these short calls are, you know, trading $3 or something right now. I don't care. I got to keep that 35 cents. That means I made the width, $25 on this trade, and out for the extra 35 cents there. Okay, so we've got the stock, right? The short strikes, short puts right there at the 200, break evens, adding in the premium that we collected, $18.09, so right there at around 218.09, and then to the downside, we're looking at about 1081, right? 181, I can't get it. So that would be a good strategy. You can see that our premium to get is better than our premium that we're going to lose. It's very close to being 1-to-1 though. So risking 1 to make 1. Okay. Anybody else have any other questions? Alexander likes this strategy. Yes, it's got to be market neutral though. And remember, get out early. This is our trading course special, you guys, that you can take advantage of. I don't think, Raj, that we have the earnings on this one. We do have the volatility crush, which is huge. If you guys like selling premium or want to learn more about how to sell premium so that you have, do I have an alert service? I don't know what you mean by that, Raj. I don't give trade recommendations. I just talk about my trades. So you can get all 4 courses for $497. So you get the hacks that'll streamline your process. The volatility crush will allow you to sleep at night. Raj, I do have a service where you can watch all of my daily market commentaries. And you know, if you have any questions whatsoever, you have unfettered access to me. Whether I need to call you over there, and I don't know where you said you were. I think, oh no, that wasn't. Yeah, here's the email, trading@protraderstrategies.com, so you can take advantage of that. Oh, you're in Missouri. Yeah. So yeah, I can easily call there. So yeah, talk to us about that, where you can get that premium membership offer, and you get everything then. And basic options, this kind of history, this, if you're newer to options trading, I would probably start with that one there and start learning that, then maybe go to the volatility crush so you can understand that. And then learn trade options like the Wolfman. We go through all of the deltas, really breaking that down. Actually, you probably should start with this one. Go to the trade like the Wolfman, do the volatility crush, and then the hacks in there in between, in and around there as well. All right, so all of those, $497. You should take advantage of this, especially while you're in quarantine. You know, by the time you get done with this, you guys will be much more confident. One thing I say is, when you're confident in your trades, then, you know, you are going to be a better trader. You're not going to jump at any type of panic. Because, you know, panic comes from not understanding and doing silly things like Portnoy going out there and going all in on Amazon is just not understanding the risks. You know, he didn't even know he was trading on margin, you guys. So when he thought he was doing, he had $1 million invested in Lululemon, he was trading on margin. So he actually had like $3 million. Now, keep in mind, he's worth $100 million, but still just not understanding what he was doing. By the time you go through all of this, you guys are going to understand options. You aren't going to get panicky. Like I said, you know, you're going to be able to sleep at night. So take advantage of this. Also, I want to thank you guys. That is the link. I got the link for this webinar over, or for this course over in the chat window. We've been going back and forth in the questions box. So in the chat window, I just flipped the link over there. If you're watching on tape delay, it's at the top. And if you want to email us, trading@protraderstrategies.com, or call us at 310-598-6677. Keep in mind, I'm going to be doing more webinars on trades I find, when and where I find those. Daily market commentaries, I talk about all my trades. Win, lose, or draw, when those trades go against me, they're in my face. I'm not trying to cover it up. I'm not acting like they're not there. You know, like you get from people on TV where they just, they put out, hey, let's get long, whatever, and it goes against them, and you just never hear about it. When it goes against me, you're hearing about it. Why? Because that's what I'm dealing with on a daily basis in real life. All right. So, and how we stay mechanical, lower the overall cost basis, increase our probabilities of success. That's what I'm trying to teach here. All right. Here's also the link if you're watching on tape delay. You have to type it into your URL. And finally, one other thing that we got to go over is keep in mind, we are an educational company. Past performance of any trading system or methodology is not necessarily indicative of future results. And take a moment to go over the disclaimer, as we are not here to give you financial advice, which is why I don't give trade recommendations. I don't believe in trade recommendations, you guys. I wholeheartedly do not believe in anyone giving out trade recommendations, because they don't know what's in your portfolio. You know, just like we were talking about gold, it's going to trade sideways. Alexander's like, dude, you are nuts. It's going to 2,500 or whatever. Exactly. Your market assumption may very well be better than mine. I'm not saying I'm always right. Believe me, I've known over 25 years that no matter how sure I am of something, I have seen it not work out, okay? Just like the guy we were talking about, Portnoy. I don't care how sure you are that Amazon is delivering packages to everybody in quarantine all day long. It might not go up on an earnings beat, all right? All right. Other than that, if you can't take that, take it easy, guys. Take care. I see you throwing some out there, John. Or give me 1 second here. Take care, you guys. Thank you for all the kind words. Appreciate it.